everybody, this is Colin podcasting about real estate, and welcome to show number 3. Today I'm talking with an old friend of mine, Graham Parham from Highlands Mortgages. I've known Graham for 5+ years and he's been in the business 20+ years. And in addition to running a very successful lending company that does 50 to 60 mortgages per month, the vast majority of whom are to real estate investors building rental portfolios, Graham is also an extensive real estate investor in his own right with dozens of properties in many different states. And he's probably the most investor friendly lender that I've ever met. And we have a very great chat today, and it's a wide ranging interview where we discuss the types of loans that are still easy to get nowadays and the ones that have suddenly gotten a lot more difficult. We discuss how Graham has actually grown his business during the last 3 or 4 months, how him and his staff are busier than ever. We also talk about the reserve criteria that lenders look for people applying for a loan, and what Graham uses as his personal reserve criteria for his own rentals what he's acquiring. We talk about his thoughts and my thoughts on the wider economy and how different asset classes are being affected by the COVID-19 virus, some of which are proving remarkably steady and growing. Others are in pretty big trouble. We talk about which is which. We also talk about the silly mistakes that people make again and again that derail their own loan application process. You'd be amazed at what can derail a loan application. You'd also be amazed at some of the mistakes people make and some of the decisions they take during the period between reserving a property and buying a property that are a total no-go. And we also talk about what the best entity is to purchase and hold the real estate in terms of asset protection, and how to get around any Fannie Freddie restrictions that might be there and might trip some people up. And we talk about a lot of things as well. Like I say, Graham's a good friend of mine. This is a very nice, wide-ranging conversation, and I think you're going to enjoy it. Graham, how you doing? Good to see you again. Welcome to the show.
Colin, how are you, sir?
I'm doing
Good to
great.
see you.
Hmm.
I need to make another journey down to Tampa here soon.
You do. You're not suffering too much in that big house in Texas either, though, are you?
Yeah, well, it's not that big. It's only 3,000, but we call it home.
It's a small house for Texas, maybe, but yeah, big for everywhere
Yeah,
else.
yeah, that's true. That's true. Small house for Texas.
So
So,
listen, I've known you for many years. We've done a lot of business together, but for people that don't know you, can you introduce yourself to the guys
sure.
out there and tell us a bit about yourself?
Sure. My name is Graham Parham. I'm with Highlands Residential Mortgage. I'm a loan officer here. Been with them, I don't know, roughly over 5 years now, but been in the industry for about 21. And all I do is work with investors that's just getting started with their portfolio. Been doing that for roughly 20 years. We'll close quite a few loans. We're running about 60, 70 loans a month. And I'm also an investor, as you well know, Colin. I picked up a couple properties from you and constantly trying to buy properties throughout the U.S. Through all kinds of different sources. But I really enjoy, working with clients that are trying to, grow their portfolio because, I tell them I had two hats, one as a loan officer, one as an investor. And really being an investor does help them a lot, especially stay on the right path. Because I've always said the smartest people can make the dumbest mistakes, and they really can. So my job is to keep them on the right path and make sure everything in its accordance of growing their portfolio. But it's been great. Our business is good. I got a great team. Have about 10 people now. You've met some of them, Aaron, of course. But we're located out of Dallas, Texas. We're privately held. I do business all over the U.S. So that's kind of the sum of it.
Okay. No, I know I've worked with you many times personally, and a lot of the people I've sold properties to have worked you over the years, and you're definitely an investor-friendly lender. And that's a minority in the lending world in my experience. And just getting on to real estate, Graham, I know the real estate market in my area in Tampa, Florida, affordable single-family homes, has been unbelievably resilient these past few months. And aside from some last-minute verification of employment requirements, I personally haven't noticed a lot of difference with lenders getting loans closed, or our buyers who are predominantly investors having much difficulty getting their loans closed. So aside from having presumably all your people work remotely instead of in an office, how's your business changed in the last 3 4 months?
It's grown. It's business as usual, but we've made some major strides. Um, to kind of summarize in a nutshell where we are today is back we're under a somewhat of a liquidity problem. We are under a liquidity problem, which what that means is back in probably first part of March, first couple of weeks of March, all the rates dropped considerably. Everybody and their mother jumped in and said, I want to refinance my house. A normal funding year conventionally is usually about $4 trillion a year. In that first couple of weeks, the applications for, all throughout the whole industry was $1.3 trillion. Well, that crushed the system, crushed everybody's system, caused liquidity problems. The Fed's jumped in many times over buying mortgage-backed securities just to keep these institutions open. We have not experienced some of the pain that a lot of the other lenders have because of they're just basically hemorrhaging and they're overloaded. So what a lot of lenders have done is they say, okay, we want to slow the production down, so they raise the rates. Well, we're not in that boat for some reason. We have a different arrangement we'd sell our loans directly to Fannie, and it's business as usual. I mean, the rates are very, very competitive. The inventory is good right now. Colin, I don't need to tell you that's nationwide, and you can allude to your inventory. But inventories are good. Some of the competitors are not on the playing field. What that means is a borrower's competitor, because there's still some people that are sitting on the sidelines kind of waiting to see. The smart and savvy people, they're jumping in. And, throughout the whole country, you've even shared with you what's going on in your market, that the markets are still good. They're still going. They haven't been hit hard by any depreciations or loss of sales. I mean, I've heard some statistics this morning about, the builders are getting back in the game. They're starting to ramp back up. So it's good. But you did touch on one thing about the verification of employment. The only thing that really has changed in the Fannie world is because of the COVID thing, is that the self-employed people that have a business that may, like a service business or something that would have impacted them more so than other types of business. Well, we want to make sure that we look at those people a little bit harder. So we're getting profit and loss statements from the beginning of the year till now to show that they're still healthy. Okay, and yes, we are verifying the employments with everybody just to make sure they're still there, they're gainfully employed, they're back at work, they're still making the same pay, so forth and so on. So that's really the only change. It's a little bit more critical of making sure people are still making that money like they have been prior to post, COVID. So other than that, everything's the same.
So just you've tightened your underwriting criteria slightly in terms of verifying people's employment, for the simple reason
Yeah,
that unemployment has shot up in the last 3 or 4 months, and it's kind of what happened after the last crisis as well. There was a lot of crazy loans given out, and then standards tightened considerably, and like it hasn't been that easy for a lot of people to get loans over the last 5 to 8 years. And if you did qualify, if you did have a good W-2 job, you're able to get lots of loans at competitive rates. And it sounds like you're still able to do that as long as you're in the fortunate position of having a reliable income stream and having a provable income stream.
absolutely. And, uh, if you're not jumping in the game right now, you need to rethink it, because once again, the rates are down, the inventory's good. I mean, everything makes sense. All the numbers make sense for everybody to jump in right now. And I'm still continuously look. I tap you on the shoulder from time to time. What do you got? What do you got?
Mm-hmm.
And because I'm always trying to buy. The problem with me is that the only people that are left standing right now because of the liquidity problem is Fannie Mae and Freddie Mac. The non-recourse lenders, the portfolio lenders, commercial lenders, jumbo lenders, non-QM lenders, they've left the playing field temporarily. And when they'll come back, we don't know. I was talking to the head of our operations yesterday, and they don't think that the non-QM is going to be back until the end of the year or fourth quarter, which is unfortunate because that's the kind of money that I have to use because I have more than 10 loans. So anybody in the side of the 10 box, it's business as usual. Bring it on.
So just in case some people didn't follow it, if you're already a very experienced buy and hold investor and you've got 15 or 10, 15, 20 plus rentals, it's gotten a lot harder for you to borrow money now to get additional rentals. But if you're earlier in the process and you've only got one or two or three or four or five conventional loans that Fannie and Freddie are happy to insure up to what, 10 per person, you're still good to go as long as your income
Yes,
ticks the right
yes, it's
boxes.
all good. It's all good. There's some lenders out there that have put some additional overlays over and beyond the one I just mentioned about verifying the employment. But beyond that, it's business as usual. And so a lot of those ones that we deliver the loans to, we
Mhm.
stop delivering to because we don't want to deal with those overlays. So 100% of all my loans are going directly to Fannie. It's making the world so much better. Our
Okay.
pricing's in line with them. I mean, for the last 6, 8 weeks, it's been great. It really has.
No, I'm delighted to hear it. And one thing people need to realize is you'll see the headlines on the news about the record low interest rates, and they usually refer to first, homeowners, primary residence interest rates. So what interest rates realistically are people able to get for buying rental properties and financing rental properties, and what kind of deposits do they have to put down to get it?
Well, the down payment requirements for single family is 20%. Some lenders out there limit that 20% up to like 6 loans or 7, whatever. We go all the way to 10. The 2 to 4 units are 25% down. The pricing these days, it's really compiled of 4 different components. One, of course, is your credit score, percentage of down pay, loan amount, and property type. But the range today is probably anywhere from 3.625 to 4% with no points on a 30-year fixed rate for an investor loan. So, those are smoking hot rates. There's no doubt
Yeah.
about it. Any investor out there will tell you.
That's fantastic because I know I've got multifamily loans for you that were in the mid fours, even to the high
Yeah,
fours a couple of years ago, and
yeah,
single family loans in the low fours to mid fours, and that's a huge difference. I mean, when you add up the interest payments and the difference between a 3.9% loan and a 4.6% loan over 15, 20, 30 years, you're talking about thousands and thousands, sometimes tens of thousands of dollars
yep,
that you would save by locking in those rates now compared to
yep.
buying at a higher rate.
And there's a lot of people that are considering the refinancing of some of those notes that, like you just said a year ago. And the math a lot of times on refinances just don't work. It just, time is not your favor, because when you do it too soon, even if you drop from, like you say, 475 to 375, you may only pick up 30, 40, $50 in payment. But you got at least to get at least 100 to $150 for it to make sense, because the same kind of closing costs that you had when you bought are very much the same way. And even though they do roll it into the loan, on paper, you want to make sure you can justify that. And that's why I usually benchmark at about 100 to 150, because that gives you return within about 3 to 5 years.
Yeah, no, I agree. If you bought a house and you're trying to refinance it 6 or 12 months later, you're adding an awful lot of loan expenses onto your balance sheet for that. It makes more sense if people have owned them for a while and they've built up quite a decent amount of liquidity and want to refinance it and reduce their payments, like you say, by 150 bucks, then it's a no-brainer. And obviously, record numbers of people have been doing that. I don't know what percentage of those meet that criteria you just said. And I suspect there are a lot of people refinancing that might not have done so if they really looked at their spreadsheets properly. But the herd mentality was there, and crazy amounts of people have been rushing to do it, right?
I've been turning more people down of refinancing right now than I've been taking, simply because of the length of time and the size of the loan. That has a lot to do with it, because the percentage of 100,000 versus the percentage of 1 million, the dollars add up a lot greater with the larger loans. So these smaller loans, 100 to $125,000, a lot of times just doesn't make sense in a
Yeah.
short period of time.
Yeah, I agree. But look, you've alluded to the fact that you're an investor as well as a loan officer. How have your rentals performed lately? I know you own rental properties here in Florida that we sold to, but I know you have others in other states as well. A lot of people were worried about defaults at the end of March, end of April, end of May. How's your personal portfolio been doing?
Well, me personally, I'm at 100%. I'm great. I think I might have stumped my toe on a couple of your properties. No, I'm just kidding. No, actually, everybody's been really good. We got in April. Everybody was taking a deep breath there, and took another deep breath in May and got that in. And here we are in June. I started seeing some of the numbers coming in, and it's been good. We haven't missed a lick. So I asked that question to a lot of providers, not just in your area, but all over the country. And everybody's running about 90, 92%. And if you take a look at those numbers, that's not too far off from the normal average. So it's like people realize they still need a place to live and they don't want to mess that up. So they're paying it. I mean, yeah, there's going to be a time or two, depending on the management company that you talk to. But I think overall, we're all very, very pleased.
Yeah, I've had the same experience. I've, the property manager I work with here in Tampa, it's been remarkably steady, the same as the normal March, April, May. I have rentals in Ohio and Alabama as well, and the property managers there, confirm I've collected all the rent in those. Their companies seem to be at similar percentages. I mean, they have, probably 5x their communications with tenants just to make sure everybody understands, what they need to do and what options are out there if anybody's struggling. But it's been great, and fingers crossed it will continue. And I think people need to realize that even though the wider economy is getting hit, and some of the hits are still in the pipeline, there's a big difference between a tenant living in a house and office or retail or hotel or short-term lets. That they're totally different markets, and they're in fact they're being affected in a whole different way than your regular middle class rental properties, which I think is probably one of the safest places to have your money now.
It really is. I mean, I would hate to be in retail right now or any type of commercial type of products that would require those kind of tenants. I mean, right now the owner occupied, or excuse me, the tenant occupied, for individuals is great. For houses, fourplexes, even apartments for that matter, everybody's doing really well. It's just the commercial stuff's the one's been hurting. But of course, the government's stepping in and helping them out, with some of the SBA stuff. And so that seems to take a little pressure off. But for the most part, the best place to be right now is in residential. I mean, we're all doing good.
Yeah, we're all doing good, absolutely. Well, what are your thoughts on the real estate market in general and the wider economy in general? Do you think there's obviously a massive amount of liquidity in the system at the minute, which is, possibly propping up asset prices? Is that going to continue to push them up? I mean, it's kind of unprecedented what's happening, so we can't really say they're going to keep going up for 3 years or they're going to collapse in the fall. I mean, I certainly don't have any idea. And I mean, what's your take on how things are going, and what's your opinion on what's a safe way to progress and keep your money invested, but possibly not investing it all at once?
Well, I mean, a good example, you and I both know a guy named Ben Smith. He asked this question prior to COVID. He said, okay, when the economy starts to swing, are you ready? I'm going, well, sure, I'm ready. He says, well, how's that going to impact your rentals? I'm going, it's not. I mean, I own the asset. It's worth this amount of money. I'm getting this kind of rent out of it. Even if we have a little bit of a soften in the economy, that tenant's still going to live there. They're still going to make the same payment. The only thing that's going to go up is rents and taxes. And so that's just an example. But I think, well, the 30-year fixed rate price is going to be around forever. I think Fannie and Freddie are going to be solid for quite some time because it's still government backed. There are some rumors of taking it back to the private sector. Good and bads to it. The bad part is people suspect if it goes back to the private sector that the private sector is going to be a little more conservative, so they may change some of the guidelines to make it a little more stringent. I don't know. It's hard to say. I just don't see that happening anytime. I think the goal was to take it private in 2021, but I think the whole election thing will have a lot of impact on that whole situation. So, a lot of people say, we're going to come up to Armageddon next year. I don't believe that. I'm not a pessimist. I'm a true optimist. And I think it's going to be business as usual for quite some time. I think this COVID thing will catch up. I think we'll get the vaccination. Even though some of the cases in some areas say they're going up, well, that's because they're all being tested now, where before they weren't. So there's all kinds of ways to look at that. As an economy, I mean, every market I talk to is strong as it can be. I'm in Dallas, Texas, and it's just going gangbusters right now. And even on the West Coast, I'm not seeing any hits or depreciations or suffering economy out there, even on the West Coast. And they're one of the first ones to go, as we all know. And so far it's been good. I feel like we're still going to be strong for a while.
Mm-hmm. No, there's a strong case for that for sure. I can't disagree with you. I think it's always been dangerous to bet against the U.S. economy, right, and bet against the dollars. That privileged position as the world's reserve currency. It's got a lot of key strengths that other economies just can't match, and that's probably not going to change for maybe several decades. So yeah, I would agree with you. It's not necessarily a time to hunker down and core in the shadows. The real estate is still a safe place to put your money. And look, you've always had to be careful investing in real estate, investing in your money. I mean, I know when people are taking loans out, the lenders will have certain reserve requirements. They're going to want to see that people have a certain amount of money in savings, for rainy day money. What are the current requirements out there so that people can kind of know if they have enough cash to qualify for a loan? But aside from that, what kind of common sense advice might you have for people about what kind of money they're really realistically going to need if they want to buy their first, second, third rentals?
Well, it depends on the individual that you talk to, of their peace of mind, of the kind of cash reserves they want to keep on hand personally, which has nothing to do with real estate. The reserve requirements, as far as we're concerned, if it all depends on how many properties and how many loans you have. as an example, if you have like from 2 to 4 loans that are currently in place, then the reserve requirements is like 2%. Let's just say those 2 to 4 loans added up to 100,000. Then, of course, we need to see $2,000 on hand. And then once then go to 5 to 6, the percentage is 4% of whatever the aggregate loan amount is. And what that means is however many loans you got, and if it adds up to a certain dollar amount, then you take that or that 2 or 4% and you do the multiplier against that, and then I'll give you the dollars and cents that's reserved. And then, of course, beyond 6 to 10, it changes up to 6%. Now, the good thing is that the reserve requirements, we can use non-liquid funds, IRA, 401k, anything that you have, that you're not going to touch, of course. The only thing we did see, and there's another change we see, we were normally given 100% of those funds as a total dollar amount for reserves. They kicked them back to 70 temporarily, which is not a big deal. If you have 100,000 in your 401k and you need, say, 20,000 for reserves, not a big deal. But if you're running tight, we do bring it down to 70%. So it's still not a big deal. 70% is much better than what it used to be at 60% before they changed it to 100. So that's what we use primarily for a lot of the reserves is people have non-liquid stuff, and because they do always ask, well, how much do I have to have on hand? Well, do you have an IRA? Well, yeah. Well, then bring that to me. Okay, good. So the reserve requirements hasn't been a problem.
And what about practically speaking? Somebody's taking out $100,000 loan, they're getting $1,000 a month in rent. I mean, what reserves should they have anyway for rainy day money? Do you have a particular opinion on that, or what do you have a special formula that you use to calculate what reserves you need to have on hand for all your rentals?
Well, the old rule was 6 months,
Mm-hmm.
PITI, okay, principal, interest, tax, and insurance. I still think that's a good number to
Mm-hmm.
have in reserves. And the newbie starting off getting one property and all of a sudden it goes vacant. They're in panic mode. And when you start to add to your inventory and you get up to 5 or 6 or 7 property, having one go empty for a month or two, you hardly even bat an eye at it. It's just really weird. I was told that when I first started off buying properties about 16 years ago, and now I understand it because it's not that big a deal. Well, all right, go ahead and put another tenant in. So yeah, I mean the onesies twosies out there will feel a little bit harder than the people that are really trying to grow their portfolio. But 6 months, I think it's a good average. I mean that should cover you for a while because I mean in this market right now, if you can't get your house rented in 6 months, then you're in the wrong market and you're in the wrong management company. That's all I got to say.
Yep. And I agree. I try and set aside 6 months of running costs with my different rentals. And I couldn't agree with you more that the onesie, twosie stuff, you get a lot more stressed out about it. You sweat the small stuff a lot more. And, you might think you've 5 times the problems having 5 rentals than one rental. You actually probably have less stress and possibly even less time thinking about them. And 10 rentals compared to 5 rentals, again, it's not twice as stressful. The more you have, and the more people you have in place and the more money you have coming in from different directions, you tend not to sweat the small stuff. You tend not to sweat getting a new water heater, a new boiler in one single individual unit because, chances are the majority of the others are going to be firing on all cylinders at the same time. So yeah, you just keep building it up there with those reserves. Another thing I see people getting tangled up in sometimes, which, for me is just totally unnecessary, is they keep thinking about what kind of entity they need to use to buy their asset, what they need to get for protection. Should it be an LLC or a corporation or a trust or an IRA or their own name or their spouse's name? I mean, people get to probably think about it too much at the beginning of their careers when it, you should probably try and complicate it a little later in your career. Talk to us about your clients that do this and what entities they use and, how it should be done properly.
If I had $1 for every time I had this conversation, I'd have a lot of money. So it's misinterpreted a lot of times how people need to do that. And that's some of the things that I try to share with them as they're growing their portfolio, because I have entities on each one of my properties. Each one of my properties is in an LLC. The key to that whole thing is finding an accountant and an attorney that can agree on this subject. Okay. It's interesting to see because your attorney is going to say, well, you don't want to put like 5 properties in one LLC. You want to, spread them out, put 1 or 2 or maybe 1 per, and then the accountant will come back and say, no, it's not necessary. So if you get those to agree, then that's a good thing. So, but as far as the LLC entity, I think it's a good thing for asset protection. Yeah, you can go land trust. You can go S corps. These are all accounting questions. I think generally speaking, the single member LLC is the easiest way that I've found, especially for tax purposes, because it's a flow through on your tax statement. It's easier for preparing your taxes, but it still gives you that asset protection. I started off. Did mine about a year ago, and I put them all in separate LLCs. I'm beginning to rethink that now, so I'm going to start doing probably 3 to 4 per LLC, and I think that's enough of an exposure per LLC, because even though the LLC is going to be tough to breach, it can be breached. And if they are, then of course the other 2 or 3 properties could be exposed at the same time. Yeah, but the likelihood of that happening is very slim. So that's why I'm kind of changing my thoughts on that. But yes, do get with an attorney or an accountant to make sure they all agree on this subject, and then go have them prepare the LLC accordingly. As far as lending is concerned, Fannie Mae and Freddie Mac still today, and this is where my lender hat goes on, we do not allow to fund the loan in an LLC. That's been that way for years. So as a workaround, now here goes my investor hat on. As a workaround, I tell all my clients, give it a couple, 3 months, let the dust settle. We're going to sell the note off to Fannie Freddie. The note holder is going to buy it. They're going to review the file, basically re-underwrite it, make sure everything's in place, and then they buy the loan, send us the money back. They set it up in their servicing queue, and then at that point, the dust is settled. And get your LLC documents in your deed of trust, send it over to an escrow officer or an attorney, and just have them retitle. You don't want to pick up the phone, call the servicer, and talk with an individual on the other end making $8.50 an hour, saying, "Well, we may have to call that note due." Well, I've been at this 21 years. I've had this speech a gazillion times. I've never seen the note called due. You stop payment on the note, they'll call it due. But beyond that, they really just don't care. It's kind of up to about a year ago, even Fannie kind of rewrote their guidelines. It's very hard to interpret, but they basically said, we understand these people are going to do that. We understand these people want asset protection. We are going to somewhat kind of allow it. It's kind of hard to explain if you read the guidelines. So really, it's really not a big deal like it used to be.
Yeah, they're just going to turn a blind eye as long as you keep servicing the loan. And
right, exactly.
And good luck getting an attorney and accountant to agree on anything. I think if you ask a question to one attorney and one accountant, you're going to get 3 or 4 opinions. So I've found that
it
easy.
took me forever to find mine. Yeah.
Okay, but what kind of mistakes do you see investors making when it comes to getting finance? How do people trip themselves up and do stupid stuff? Just before they're closing. What advice do you have that people to people that are in the process of getting a loans to make sure it goes smoothly?
Well, these days, it seems like the biggest ones are people going on vacation out of the country. Okay. 99.9% of all of our closings are done via mobile notary and anywhere in the US. Okay. But we cannot do those out of the country. And the people that let's just say they live abroad, what they normally do is set up an appointment at the embassies or the consulates. Well, they're closed down. You can't get in them. And so that's our biggest challenge right now. It's, people trying to close. And every time I've got like probably a dozen loans right now. I've got 4 in the UK. I got a couple in Afghanistan. I got a guy on a military ship that can't get off. These are big challenges. But fortunately, we're starting to address these on a technological basis where hopefully sometime in the next 3 weeks, we're going to be launching this thing called RON, which is the remote online closing, which is going to be done very similar to what you and I are doing now. The title person or the notary person will be on Zoom. They'll watch you sign. You hold up your ID. Here's my ID, and they sign it, and it's all done electronically. It's going to be really slick, and it's going to eliminate a lot of the human factor when it comes to mobile notaries. So that's our biggest challenge right now. The other ones are people saying, well, I'm going to retire here next month. Well, when I call your employer and ask you, are you still on job? Yes, but they're retiring next month. Well, you shot yourself in the foot. Well, I didn't think that was a big deal. I'm making money as we're doing the loan now, but you're not going to. The Dodd-Frank Act requires us to do this thing called the ability to repay the loan. So we have to prove that. And if we can't prove it all the way, then we end up getting the loan back, and we don't want it back. Other mistakes, I would say go out and buy something you shouldn't buy. Don't go out and buy that big ship or that big boat, because you're going to jack your ratios up. Right now, we're looking at your ratios based upon your current situation. And if you think about buying a new car, or your car's busted, or you total it, you give me a call and say, hey, can I go buy a new car? And I'm going to run the number and say, well, your current car payment is this, your new car payment is going to be that. Go for it. Okay. But a lot of times I'll talk people out of it. Okay. So there's all kinds of weird things that, like I say, the smartest people will make the dumbest mistakes.
Yeah.
But primarily, leaving your job, don't go buy any big assets, don't jack up your credit, leave everything normal till the day of closing. And then if you want to go crazy after that, I don't care.
Yeah. And if you're going to receive a big lump sum of money from your Aunt Mary in Virginia, maybe just hold off on those kinds of little
Exactly.
transactions as well.
And that is another good one. Once we do interview and screen these people thoroughly up front. Where's the money coming from? Okay. Well, I'm getting it from mom. Well, if you were buying a primary residence, that would be okay, but you're not. You're buying investment properties, and gift funds are not allowed there. So what has to happen is, okay, if that's your only source of down payment, closing costs, and reserves, then you have to put that in the bank today from mom, and you got to sit on it for 60 days. You got to let it season. Because when we go through underwriting, we're going to look at 2-month statements. And of those 2 months, if we don't see any large deposits, then we're fine. We say, okay, that's your money. We see that large deposit, we're going to ask you where'd it come from. You're going to say it came from mom, and that'll blow the deal right there.
That's really good advice. So if somebody is looking to buy a rental property and they're fortunate enough to have a mom or a dad that's going to fund that down payment and their closing costs for them, make sure you receive it 2 months before you go processing that loan.
Yeah, inheritance is one thing. Mom died, we inherited a bunch of money. That's okay. We'll document the wills and all that just to validate, where the money came from. But a true gift, no, we can't use those.
Mm-hmm. Okay, so what other, can you think of anything particularly crazy that's happened with a borrower during the last few months? Something that's out of the ordinary, maybe a little bit funny or weird that you can share with us?
Um,
Putting you on the spot now.
Besides what I just talked about, not really. Uh, it's just, just this whole being, this guy's been, that keeps coming to mind, this guy on the ship. He's been on that ship for like 8 weeks, and he
Right.
keeps coming into port. We say, fine, where are you porting? Can't you find a mobile notary on the ship? It's just like, come on, man. There's just like one big challenge to get this guy to close. But beyond that, really nothing too crazy
Mm-hmm.
lately. Everything's been pretty normal.
No, it's awesome. I'm delighted that your business has been growing during the last 3 months. I think a lot of people would be surprised to hear that a residential lender is growing, but I can see it and I know it's to be true as well. Because you're a residential lender. You're not lending money for office space or retail space or malls or hotels or any of these other asset classes that are in a totally different world of pain right now. And somebody who specializes in selling Fannie and Freddie loans, which are basically implicitly guaranteed by the government and probably will be for quite a
Oh,
while. It's a different story.
yeah, like I say, it's been business as usual, and everybody's pipelines have increased because of the refinancing. We as a company, our philosophy is always to focus on the purchase loans first. So they always take precedence over the refinances. We get report cards every month. My report card came in last month, and my average close time was like 26 days, which was great. And most lenders right now, because of the refinances and everybody's clogged pipeline, they're 60, 90 days out. They don't care. They don't do the prioritizing like we do or I do, our company does. And if they don't, they're being foolish about it because they're going to lose all the referral partners. But that's where we focus on. And, of that turn time, I'm still like 92, 93% purchase. So I don't do as many refinances as you would think because of the scenario that we talked about earlier. I talk a lot of them out of it.
Yeah, I agree. And I personally know the difference, a huge difference in selling a property to an investor who goes through a specialist company like yours. Like you say, you get them done in 25, 30 days. I'm also selling a few properties on the retail side to FHA buyers. And it's just a whole other thing. It's just so slow, so many hiccups. You're dealing with a lot of, like you referred to, people earning $8 or $9 an hour that just, kicking cans down the road and taking 5 days to solve a problem that should be taking 15 minutes. And working with guys like you, I think is very important. Any flippers out there or any wholesalers or anybody that sells to databases of investors could do a lot worse than build a relationship with a firm like yours. So do you want to remind us how many different states do you lend in, Graham? And if anybody wants to reach out to you, how can they contact you?
25 states now. My best way would be my toll-free direct dial, and I'm 24/7. Anybody who's dealt with me, you'll know that you can reach me after hours on the weekends. If I'm available, I'll certainly take your call. But always hit my toll-free number, which is at 855 326-6802.
Okay, I will make sure I put that on the show notes and maybe your a link to your website as well. Okay. So yeah,
Okay.
thank you very much, Graham. I appreciate your time. Thanks for coming on the
Always
show.
fun, Colin.
And
We'll get together soon.
hopefully, yeah, let's get together soon in Tampa, or who knows, maybe I'll get to Dallas someday and check out that nice house.
Yeah, come on. All right. Take care.
So there you have it, folks. That was Graham Parham at Highlands Mortgages. I hope you enjoyed that show. I thought we had a very nice conversation there. I hope you picked up some useful tips and tricks. If you are an investor and you're looking to borrow conventionally during the next 3 to 6 months, I highly recommend you reach out to Highlands Mortgages. Like I said at the top of the show, Graham and his team are definitely the most investor friendly people I've dealt with. They do lend in 25 different states. I've got mortgages from them in multiple different states, and they're very easy to work with. And they genuinely try and build relationships with investors and try and help you build a rental portfolio. And that is not the norm. That is not the norm at all. So reach out to them if you are looking to acquire a mortgage and looking to buy some rentals. You do very well. Aside from that, I appreciate your continued support. If you have a minute and you're able to give us a review or a 5-star review or a comment, I'd really appreciate it. If you have some friends that you think might enjoy this show, by all means, try and share it using your email, your social media, or whatever you can do is certainly appreciated. I will be back next week with show number 4. This is Colin signing out. You guys take care. Bye bye.